We're talking about market volatility with John Bollinger. Now, John, you released some new technical indicators in the later part of 2010. Tell us how these have been signaling your trades lately.
Well, the past 2 years have been a really great time for us. After having developed Bollinger Bands and the related tools, for many years we concentrated on how to deploy those tools, the building trading systems, building trading approaches with them. And we really didn't work on building new tools and expanding the portfolio. And as you point out, we've been introducing a steady series of new tools. And a lot of that has been driven by the changing market conditions themselves. For example, the percent B is an old Bollinger Band tool. It's actually the first indicator that we ever derived from Bollinger Bands. It shows us where we are in relation to the bands. By definition, it's 1 at the upper band, it's 0.5 at the middle band, and 0 at the lower band. And if we get above the upper band, it's a value greater than 1, like 1.1, and below the lower band, it's a negative number like minus 0.2 or something like that. And so this allows us to systematize our trading ideas by incorporating percent B numbers into our trading system, so we can say if percent B was greater than 1 yesterday and is less than 1 today, that means that we've reversed at the upper band. We've had a day outside of the upper band and we're back inside. So we've taken those ideas and we've expanded them. Percent B is a great example because it was derived from stochastics. As most people know, stochastics uses not only the raw number, but they use smoothings of the raw number to produce fast stochastics and slow stochastics. So given all the market volatility, we have applied exactly that idea to percent B. So we now have not only the raw percent B, but we have a fast presentation of percent B, which is percent B and a 3-day smoothing of percent B, a slow presentation, very similar to a slow stochastic, which would be the smoothing of percent B and a further smoothing of it. And then I think best of all, we combine all three. We have the fast percent B, the raw percent B, the first smoothing and the second smoothing. And what these do, because of the incredible volatility that we've had recently, they add some smoothing to the mechanism that's generating our signals and help us eliminate some of the whipsaws that we've seen in the market recently. So what we're really doing is adapting the older techniques forward to the modern environment by adding new usages of them to already existing portfolio.
So given all the volatility then, how should the do-it-yourself trader incorporate some of these indicators?
I think that the best way is to we've had quite a run of new indicators here. Not only these versions of percent B, which I introduced at the show in Las Vegas, but we've done the same treatment for bandwidth, and we have a new indicator called BB Impulse, which is what you were talking about before. So rather than in this environment, rather than using BB Impulse as a raw number, now we can smooth BB Impulse a little bit. It shows us where the momentum is in the market. With the rapid sorts of momentum shifts that we've seen recently, BB Impulse has gotten a little bit hard to read, but the smoothing is much easier to read. So in this very volatile environment, these smoothings have helped us a lot.
Thank you very much, John.
My pleasure.
You're watching the MoneyShow.com video network.